Hi everybody, today is Saturday, August 25th, 2:47 p.m. my time. 3 articles for you this week. I'll be doing a second part as well in a separate email. It's been a while, so I'll just try to pick all the more popular stuff over the last week. First article is found from poundsterlinglive.com. Headline of the article is Australian dollar slides in risk-off market as Turnbull fights for survival. Australian dollar, worst performing G10 currency. Thursday, risk off mode. Here's how far it dropped, as you can see. Start of the Chinese-U.S. trade talks has given Asian currencies a risk-off feel overnight, and the dollar is recovering from the week's falls. Turnbull survived a confidence ballot earlier this week after calling himself, although won by narrow margin of 48-35, ballot comes ahead of general election that is expected to be held no later than May 2019. Has been infighting grip the coalition amid a poor polling performance and following a series of scandals. So the Australian dollar was the worst off for the last little while. Next up, article from Reuters.com. The name of this article, Instant View S&P 500 trades above January high, sets a record. This came out 4 days ago. If you ask me, let's see if we could pull anything out of this article. So we just got the chart here. S&P 500 Corporation. Yeah, it looks like it's gone higher. Let's see here. I'm prepared on this one. Closing above January high would mean the benchmark index ended a correction on February 8th. Light volume periods like the last week's August made it easier for equities to rally just now. ETF flows have been good over the past week, especially in the stocks with lower volume. That will tend to push stocks higher. I don't think too much about it. Long-term returns on U.S. stocks have been poor for a long time. Compounded annual growth rate for S&P over the past 20 years is 7%, below long-run averages of 10 to 11%. Even a record stretch of good returns doesn't fix the damage of 2000 to 2002. We're also encouraged that the markets have been resilient, shaking off headlines on Turkey, tariffs, and trade without a sense of euphoria, which is common at the end of market cycles. Now, I got another chart for you as well. That'll be in the next video. So here on Bloomberg.com, we got an article called Hedge Fund in Pain, Watch Record S&P 500 Rally They've Missed. So here's a chart. Hedge fund returns dwindle despite record-setting equity rally. Here's another chart. Net leverage, U.S. equity, long-short delta adjusted, realized. Weighted blue, yellow's SPX. Hedge fund favorites, trail market. Well, their most hated stocks outperform. So this is hedge funds in blue, hedge fund favorites, shorts versus S&P 500. I just also like to remind people that there is a video version on this on YouTube as well if you want to look at it. Other white line, hedge fund favorites, trail market, while their most hated stocks outperform. So that's what's going on. Why did the hedge funds miss out on this? Hedge funds have seen returns dwindling even as S&P index performance of funds focused on equities has fallen in 5 of the past 6 weeks, wiping out gains for the year. So it's a defensive stance and bad luck bets. Net leverage, measure risk appetite among hedge funds, has fallen to the lowest level this year. While the posture would have curbed losses during the market sell-off, right now it's prevented managers from reaping bigger gains. Notably, tech giants such as Facebook have suddenly stopped working. Bearish wagers backfired, with the most shorted stocks jumping for a third week in 4. So their shorts are not working out. That's pretty well it. Oh well, what's going to happen to these hedge funds as an industry, who knows? But those are the articles I've got. I'll continue in my second video.